Let's move right back to TCS, and Samir Seksaria as well as Milind Lakkad are now joining in with Anisha to take forward their conversation.
Well, yes, I have with me Mr. Samir Seksaria, the CFO, as well as Milind Lakkad, the Chief Human Resource Officer. Thank you, gentlemen, for joining us on ET Now. Let me start by asking you the question I posed to earlier, and I won't tell you what the answer is. My question to him was, are you exiting FY24 with a 25% margin band?
That's a good challenge check. Like it happens in any typical year, we take the headwind
at the start of the year,
and then we typically increase back up, and that's what you would expect in this year itself. And definitely we'd look forward towards clawing back up as far as we can. There's macro uncertainty which provides uncertainty in terms of how the pace at which we'll be able to claw back. Our intent would be to get to our 26% closer as fast as possible rather than have an intermediate number. But there's uncertainty to give a number to you.
So are you almost saying that you're not even targeting 25? The target is 26% by the end of the year?
No, I'm saying that there's uncertainty wherein I can't commit to anything and then be held accountable each quarter. But our intent would be to get 226
sooner rather than later. Okay, let's see when that sooner rather than later happens. But I'm curious about knowing this, Milind. Every time when you're making your budgets and you go to Samir to ask for that budget, is he the kind one who gives you whatever you want, or do you have to arm twist him and, you know, he's very frugal with his numbers?
I will tell you that if you look at this quarter, you know, huge hikes for our people, you know, that happened, you know, and we are neighbors on the same floor and keep good relationships with each other. Some arm twisting sometimes may happen. He will twist mine, I will twist his. But yeah, I think we are in general very good friends and make things happen.
So you're trying him to get back to that 26 to 28% mark, and he's trying you to get that 40,000 freshers that you want this year.
We'll make both of these things.
I cannot do it without him. He cannot do it without me.
Fair enough, point taken. But let me talk about the 26 to 28% aspirational band. What are the levers available? You know, subcontracting costs is one thing which we've been talking about. It's already at a 10-quarter low of around 7.4, 7.5 thereabouts, if I have it right. Do you see more upside that you can squeeze out from the subcontractor costs?
So absolutely, as you said, at 7.4, we are in the range which we operated in pre-pandemic, 7 to 7.5% range. But if you look at the uncertainty and if there's a demand-supply mismatch, this is the easiest cost to, double down upon. And that definitely remains one of the levers. And there's no hard stoppage that's the comfort level. In a low demand scenario, you can go down even further, and that can be one of it, definitely. Other levers, if you look at utilization, as we have been talking about, has been something which is low, and once we improve it, that definitely becomes a lever. Productivity is one more lever which we can double down upon.
And again, you'll have to come back to him to drive that utilization as well as productivity, right? But you're sticking with your target of around 40,000 fresher addition, and I ask you that last year, I remember in the quarter there was addition to the tune of what, 35,000 people. This quarter it's down to 500.
So we have actually made a strategic move last year that we will basically invest in our people, get more people in, significantly invest in talent development, and basically eventually make them productive in, if it take 12 to 18 months, do that. And that always worked for us. Our pyramid of what we hire is very important for us, and because that is what keeps the cost down, keeps him happy in the process, and drive it in a very effective and efficient manner.
We are talking about in a pyramid format. But then there are reports also coming in that with respect to some of the lateral hires, there has been a bit of delay as well in onboarding. Would you want to clarify there on that?
So, because of the environment, we are looking at project getting paused, sometimes tactically, sometimes for maybe a little longer term. and those pauses are basically, making us, have our onboarding aligned with that. That is the reason. So it's tactical in nature. I just want to assure everyone that we are going to onboard everyone. We are going to honor all. It's not even a
question. I don't think we asked TCS even that question whether you'll honor it or not. But is it just, let's say, a 3 to 6 months delay, or could it be longer in terms of onboarding?
I don't think it's going to be longer than that.
Okay, so 3 to 6 months is what people
Possibly,
should prepare themselves for. We talked about subcontracting as one of the levers, productivity, utilization, but the travel costs and the other discretionary costs, have they normalized, or a bit of fluctuation which is possible there as well?
So overall, if you look at some of our discretionary expenses, they have now reached a critical mass where we can start looking at optimizing them further. Post the pandemic, some of them had come low that we could allow it to have some flux into it. Yeah. That becomes one of the levers definitely in terms of looking at it. Travel from its pre-pandemic levels is still lower. But in absolute terms, it has a critical mass.
Okay, fair enough. But talk to me about overall how the pricing and realization environment is as well, because with respect to pricing, at least we haven't heard yet that there have been a large discussion around discounts or too much competition coming into the deals as well. Is that something that you are witnessing as well, or it's getting a bit more competitive and you have to kind of give away a bit of margin to get that deal?
So if we look at the overall pricing environment, it's stable. Okay. Realization perspective, on a year-on-year basis, we have got realization improvement as also. From a competitive scenario, it always remains competitively bid. There would be sole source deals or proactive deals where we can have the leverage, versus many cost optimization deals have to be competitively bid. But what the USP in terms of delivery capabilities and how we are able to structure it makes the difference.
Sure. Point taken. Milind, just wanted to come back to the point of attrition as well. It's, of course, off materially from the highs that we had seen of over 20%, 24, 25%. But when do you see them going back to the pre-COVID levels of single digit, perhaps?
Second half of this year. Not single digits, but it will go to the levels which we actually we are used to, and we are industry leading. Which over the long term range, if you look at industry leading numbers, we will get to that in the second half of the year.
So 11 to 13% by second half?
I will not give a number, but
sure.
Look at that.
Okay. Would you also want to clarify the air around the entire hiring, onboarding, issues that really came out in terms of N. Chandra also saying in the AGM that the processes will be put in place to get the checks in place. What are you doing about it? What processes are you working on?
No, I think we already said what we were supposed to say on this topic. Only thing I would say is that it was a code of conduct issue, and we just need to make sure that we continue to drive stronger awareness to our people, and also ensure that our whistleblower process is working very, very well.
Okay.
And we continue to provide strong governance to ensure that we basically can conclude these things very quickly. It's very, very important for us.
Sure, point taken. Just coming back to the discussion, Samir, and I just wanted to get a sense from you with respect to what's happening with the deals in terms of the conversions, etc. Are there a lot of delays, not only in deal conversions and execution, but there are also possibilities of cancellations and ram downs which are causing a huge delay in execution?
So one, if you look at the order book and the deal wins which have happened through the quarter, it's a very healthy order book win, and that has happened in times of uncertainty. So they have taken the decisions taking into account the macros which our customers are seeing. So I think in terms of fresh deal additions and wins, we don't see an issue, and that gives us a good comfort on the medium to long term things. As you rightly said, on the existing customers, the pauses, the timing of it, what we are seeing is not many cancellations, maybe one or two of them. It's more about re-looking at how the ROI pans out for them for taking a decision. Maybe looking at altered scope, sometimes reduced scope, looking at ways and means to give periodic smaller duration confirmations rather than give a overall commitment.
Sure, no, but the question is as well in terms of the deal conversions that you're talking about, is it specific, the deal delays rather that you're talking about, is it specific to a particular client, a particular vertical, a particular geography, or is it very broad-based? Could you spell out something in terms of what the internals of these demands are?
I think it is quite broad-based. It is across verticals. So, in that, some verticals like the high-tech or comms, where they have made significant investments, and with high interest rates, customers in that segment are impacted. Might have a slightly higher proportion, but I would call it more broad-based.
BFSI?
It's broad-based, so BFSI also included in it.
No, but in the sense,
So
BFSI...
in BFSI, if you look at it, see, the retail banks with interest rate hikes helping them are doing quite well. Then on a combination of capital markets and mortgage players, they are impacted. Whereas if you look at then the insurance companies, the property and casualty companies are the ones which are in some amount of softness or a weak spot, but the life insurance companies look good.
Okay, so that's the take coming in. Generative AI is, of course, one thing which a lot of your customers and clients have been talking about as well. So, Milind, the question on that is, what are you doing in terms of getting the right talent for it, the training? What's the process in place to make sure that you're able to tap this generative AI potential?
So I think we have multiple things, multiple avenues or directions or strategies we have in terms of addressing this particular opportunity. Training is very important. We already have 100,000 associates trained on AI. 100,000 associates trained on AI. Basically, we will continue to get them to expand their skills on Gen AI. Specifically, our R&D also is looking into various aspects of how do we go about getting into various ecosystems and expand our capability that way. And we are already doing some 50 projects on this, so that gives us a very, very strong industry specific exposure on Gen AI, and all of this come together to basically build a very strong capability for us.
Okay, just a question with respect to the entire hybrid work culture, etc. as well. I understand a lot of people are already back to office, etc. But that entire plan of 25, 25, 25, is that on track, or what's the thought process behind that at this point of time?
Anisha, we want to get everybody back to work first.
Okay.
It's important that we have got a lot of people joined us in the last 3 years. It is important that they understand what TCS way and what is the TCS culture and what does it mean to be working in an environment where you can learn from each other, where you basically see value in basically being together with other people and see the value of teamwork. All of this is very important. So getting back them to work first is our first milestone. Everybody to work, 100%, 100%. And then subsequently we'll, over a period of time, we'll look into the model which we eventually go to.
Okay, so that's the priority one for you, getting everybody back. What's the priority one for you?
My priority one is enabling business. Our priority would be, given the circumstances, how we ensure growth with profitability, a combination of both.
And you're sticking to that $50 billion aspiration by 2030?
So if you look at the pace at which we have been growing, right, a CAGR of 8%. Even now, if we take that 8 to 8.5%, we would reach 50 billion by 2030.
So this year, at least 8 to 10% is in the bag, right?
No, I didn't say that. I'm saying for the decade, if we have the CAGR of 8 to 10%, we get to the 50 billion target.
Okay, on that note, gentlemen, I'll let you go. Thank you so much for making time and speaking with ET Now.
Yeah.
Thank you.